Welcome back to the Finance for Riches YouTube channel. Today we're continuing on with part 2 of our rental income segment of the passive income video series. So, what we're going to look at now is the net return on rental properties, rental income. Now, your rental income is going to be your main source of cash inflow, and generally you're going to compare this with the costs which you've got to outlay. So the typical costs for a rental property will include interest. That's probably going to be the largest one. You also have to factor in rates depending on the terms of your agreement, how old your property is, and your plumbing, your water, your insurance costs, your repairs and maintenance, and your real estate agent commissions. Now, I've just mentioned those costs which you're going to have to pay, but interestingly, I mentioned in the last video the concept of negative gearing. So negative gearing, that's a tax shield. Well, not even a tax shield, it's more of a tax benefit which you'll get from having rental property, and that's through depreciation deductions. Now, that in itself can actually provide a sizable cash inflow. In reality, it can if it's done properly. So that negative gearing concept's got to be added with at the end of the financial year. That negative gearing receipt from the ATO, Australian Taxation Office, but the revenue authorities in your country, it's got to be added with your rental income. So when you add your negative gearing refund on your tax with your rental income, you ideally, the sum of those two will end up giving you a positive position when compared to all your costs. Now, there's a slight variation of this which you can take into account. You can look at your return based on cash flow basis or on an accounting basis, I guess. If you look at a cash flow basis, you should, on top of interest, you should also take into account principal repayments, because your principal repayments plus interest repayments is your total loan repayment you got to make. That will obviously result in more cash outflow. And we just spoke about the concept of depreciation before. We probably don't really need to touch on that when you're doing a net return calculation on rental properties, because it does, I think, overcomplicate things without really providing a true indication of your cost. But yeah, so if you want to look at it from a full cash flow point of view, that's where you look at it. You take into account your principal repayment. If you just want to look at it from more of a accounting concept point of view, you really wouldn't look at your principal repayments in your net return calculation. Now, once you've gone ahead and you looked at your rental income and your tax benefit and compared to all your costs and your principal outlay, if you choose to do so, that number you got left over, you compare that with what your cost of buying the rental property was. So your initial cost that you paid to acquire that house, that apartment, that unit, whatever it is, and then you'll get a percentage. I think in an ideal world, a good rule of thumb is to get a return which is in excess of inflation. Now, generally, inflation obviously changes from year to year depending on the economic climate, but generally, it's usually the Reserve Bank of Australia and the government usually try to keep it between 2 and 3%. So if your return divided by for a year divided by your cost of the property, if that percentage is over 3%, then as a rule of thumb, you can generally say your returns are exceeding inflation. If it's significantly higher, well done. You've obviously done quite well. But if it's below, then it's not really where you want to be. So you might have to review your unfortunately your returns and stuff and see whether this rental properties are working out for you. Now, we've spoken about returns, your cash, your annual returns, but obviously on the side as well, we'll just touch on the fact that if your properties are appreciating in value, then you're technically getting a return on the asset value as well. So that doesn't affect your passive income, but just as a side note, your increasing value of your house, your apartment, your unit, whatever it might be, that increase in capital growth is also giving you basically an unrealized return. And when you go eventually do sell that asset, that return will be realized. That also effectively give you an additional return on your investment. Now, the other thing we want to speak to you guys about is your exit strategies. So, exit strategies with rental. Out of all the assets we've spoken about so far, which give rise to passive income, I would suggest that the rental income exit strategy is probably the most complicated for a few reasons. Now, there's this concept of liquidity. The liquidity is a simple way of saying how quickly can you sell an asset and convert it to cash. When you have a house that's producing rental income, a house is generally not that liquid. So what that means is it will take more time to convert a house into cash than maybe taking money out of your bank or selling a share. And it's usually that speaks of how much a house costs. Now, even once you find yourself a seller, there's a possible delay in when you get the cash from your. Sorry, when you find yourself a buyer, there's possibly a delay in when you might get your cash from your buyer because of the terms and conditions of the sales contract. Subject to finance, subject to building and pest, 45 days, 30 days, whatever it might be. That might be an additional delay on when you get your cash. Once you get that, there's costs which you've got to pay as well when you go and sell a house. You've got to pay real estate agent commissions, which can be quite sizable. If you've got a loan, you're paying the loan down from the sale of your house. There can be mortgage fees as well, which are payable. And of course, there's legal fees on the actual process of the sale. So there's a whole bunch of costs which you have to take into account as well. But the biggest cost, the big daddy of all these, can be a taxation, capital gains tax. So if capital gains tax applies in your jurisdiction, that can be quite a sizable bill. And it's basically, at a very fundamental level, it looks at the cost that you paid to acquire your property less any possible capital works deductions. Capital works deductions are just a fancy way of saying depreciation for the building. Looks at that, looks at what you received in proceeds, compares the two, and you might be eligible to discount that gain. But that's broad, and that discount can, in Australia, is 50%, but in other countries it varies, and it also depends on what sort of structure is holding that particular house. Structures can result in a zero discount, or they can change the actual amount of the discount as well. And whatever's left over from there will be your capital gains tax. So put some numbers around this. Say you had $1 million, you sold your house for, you bought it for $500,000, and that's actually, well, and to keep it really simple, you need to claim any depreciation deductions. Say the $500,000 gain, it's held under an Australian individual for more than 12 months. That's actually also quite keen being able to be eligible for your capital gains tax discount. But times it by 50%, $250,000 is what your gain is. So that can be quite sizable. That's obviously going to be applied to your tax rate, which applies to you, and that's going to be taxable. But nonetheless, capital gains tax is also quite large and need to be taken into account. So there's a fair few costs and, I guess, complexities which are associated when you exit from a rental income, passive income strategy. Now, that is the last of rental income videos. We're going to continue on with this a little bit more in our next video, the passive income series. Guys, please like, comment, and subscribe. Please also, like I say at the end of every video, mention any particular news or any type of financial literacy you want commentary on. This is the channel people come to get the knowledge which the rich have. I'm giving you guys the knowledge that the rich have, so you're getting for free. Let's interact. This is the opportunity to leverage as much knowledge as you'd like from myself, and yeah, I'll be more than happy to help out where I can. All right, thanks guys. See you guys in the next video. Bye.